Hello friends, welcome to Madhuram Investment. Myself Ramesh Sahu, and in today's session we are going to talk about a very important profitability ratio, that is return on equity. ROE is used by many investors for making their investment decision. So let's see what we are going to learn today. In today's session we'll see what is return on equity, how to calculate return on equity, then we'll see how companies use return on equity ratio to mislead retail investor. Yes, this is very important topic. In 2008 and 9, lot of company have misused the return on equity, and in because of that, lot of retail investor lost lot of money because of it. So we will see that in detail. Then we will also see how to use return on equity for making investment decision. Then we will also see one real-time example of calculating return on equity. In As we know, return on equity is a profitability ratio, and this ratio indicates how well a company uses their asset to generate profit. And the formula to calculate return on equity is net income of a company divided by total number of shareholders' equity. So what does it mean? Let's see this in detail. Whenever any individual or organization wants to start their business, it may be a bakery shop, a toy shop, a coffee shop, or maybe a multinational company. So for starting any kind of business, he needs some kind of initial capital, right? Without a capital, it is difficult to start any kind of business. So how he or she will arrange that money? Maybe that person has his own money. So what he can do is he can put that money in the company and start his own company. Or what he can do is he can get a partner who believes in his idea and ready to invest in his company. Or what that person can do is he can go to the people and ask them to invest in his company, and in return he can pay, so he can give them some equity shareholding as a part of shareholders. Or what that person can do is he can borrow that money from the bank or a financial institution, and in return of that he has to pay some kind of interest to that bank or a financial institution. So these are the different sources from where individual or organization can arrange an initial capital for his business. So let's understand this with an example. So let's say a promoter or shareholder invested 100 crore in the company as a part of initial capital, and they needed another 100 crore. So what they did is they borrowed 100 crore from the bank as a debt for initial capital, and for which they will be paying some kind of interest to the bank. So let's assume that in the first year they have made a profit of 50 crores. So in that case, if we'll calculate the ROE will be like your profit, the profit which you made in this, and divided by your shareholders equity, because these are the shareholders invested only 100 crores. So what will happen is, if your return on equity will become 50%, even though your overall initial investment was 200 crore, but the shareholders have invested only 100 crores. That's why what we will be doing is we'll be dividing the profit by the 100 crores, and that's why our return on equity is 50%. Let's see the flip side of it. So in this we'll see how company uses the ROE to misguide the people, the retail investor, and let's see this. So as we already know, while calculating ROE, debt part is not factored in. We don't consider debt in it. So in the previous example, as we saw, the promoter invested 100 crores, and they borrowed 100 crores for the bank. So the total actual initial investment was 200 crores, and out of those 200 crores, we made 50 crores ka profit. But while calculating ROE, we only considered these 100 crore. So that's why your ROE become 50%. But as we know that the initial investment was 200 crore, so this would, if would have considered 200 crore in this, so this ROE would have been 25%, right? But just because while calculating ROE, this that debt part is not considered, that's why the ROE is showing so high. So this is how in 2008 and 9 company misused this factor. What they did is, instead of, let's say, assume this example only, instead of taking 100 crores from the investor, what they did is they took only 50 crores from the investor, and remaining 150 crores they borrowed from the bank. So in this case, what will happen is uh, your like ROE will increase further, because if 50 crores divided by 50 crores, your ROE will become 100%. So this is how in 2008 and 9 companies have misused this factor. They borrowed lot of money from the financial institution and bank, and they didn't show in ROE. As we know from this formula, the debt part is not shown. So people believe that your return on equity is very good, so that's why people invested and they got trapped in it. So this is how the ROE misused by the company. Now see how to use ROE more effectively to make any kind of decision. First thing is, ROE should only be considered for the companies those are debt free, or the companies those have minimum debt on their balance sheet. For the companies which has a debt, we should consider return on capital employed, that is ROCE, not ROE. ROCE will return on capital employed will give more clear picture for the company those have a debt on their balance sheet. ROE is greater than 15% is good. ROE is greater than 25% is good. But we should not consider only 1 year's ROE. We should see at least 3 to 5 years of ROE. If any of the company is giving more than 15% or 25% of return only for 1 year or 2 year, it should not be considered. You should see minimum 3 to 5 years of ROE. Personally, I see minimum 5 years. If any of the company which is giving a return on equity of more than 15% or 25% for last 5 years consistently, then only I consider that company for investment. I never take decision based on one quarter or 1 year's return on equities. So this is how the ROE should be used more effectively to make any kind of investment decision. Let's now understand this with the live example. For seeing ROE, I have selected company called ITC Limited. And I'm using Money Control website to check the ROE of ITC company. Let's go into financial and see the ROE of this company. So in ROE tabs, I can see since last 5 years, this company is making consistently good return on equity of more than 20%. Last 2 years, it has grown also. And if I'll see the debt on this company, debt is zero. This company is totally debt free. That's why I'm considering return on equity for this company ITC. So this is a really nice company, and this will give a good return in long term, as the return on equity is really nice. So this is how we should check for the company and consider for the investment. That's all we have for the video. Thanks for watching, and please comment in the comment section with how you like this video, and if you want me to make any video on some other topic, please let me know. And please don't forget to subscribe my channel, and thanks for watching. Have a good day.